Do you think we care enough about companies outside of public markets?
We probably don't, and we probably need to pay much more attention to them. And the reason is because the effect that public markets have on corporate behavior acts as a brake on what might be some of the worst excesses of corporate life. It's the fear, for example, of behaving towards stakeholders in a way that might cause your shareholders to lose confidence in you, that might cause the broader world to lose confidence in you. But there's much less scrutiny of privately owned companies. And for that reason, we need to care about the governance of privately owned companies, perhaps even more than we do of publicly owned companies, because the kinds of breaks, the kinds of limits that being a public corporate citizen impose are simply not there for a privately owned corporation.
Can you explain the trend towards de-equitisation, and what do you see as the challenges that it's posing?
Well, there's two ways to look at it. The first thing I would point out is, let's get a grip. It's still maybe 5% of the average portfolio weighting of an institutional investor. And institutional investors, by the way, a new study from the OECD has just come out this morning. Institutional investors account for over half of all corporate ownership. However, the trend is very, very marked, and it's not new. It's been going on for close to 20 years. And I think what we discount is the sheer volume of capital available for investment. It's basically doubled in the past 20 years, and by 2020, it will have trebled. And that's because economic growth is happening in parts of the world where it wasn't happening before, and it's capital looking for a home. And with interest rates and returns where they are today, buying a whole company or buying a large chunk of a large company owned privately looks like a way of getting your hands on a rate of return on investment that you cannot get by investing in public markets.
Do you think that shareholder stewardship is actually a force for good?
It can be. And the question is whether or not shareholders can be effective in their stewardship responsibilities. If you look at shareholder registers, you can see they are so fragmented, it's not entirely clear that what we expect of shareholders can be carried out as a practical matter. Moreover, shareholders, institutional shareholders, are terribly concerned about their cost base with all the pressure that's on fees. It costs money to intervene in companies and press them to do the right thing. And I'm not convinced that the resources are there for shareholders to be able to carry out stewardship duties effectively.